Indian equities have shown resilience amid global volatility since the beginning of the year. However, India is finally catching up with the global underperformance which was visible in the September series. If the US economy enters a recession and the Fed continues to tighten, can Indian equities decouple and outperform? That's the big question in the minds of the investors. So CNBC-TV18 did a poll across top fund managers in India on how should investors navigate the global volatility in the near term. The first question that we asked the fund manager is, what is the biggest risk for Indian equities in the second half of FY23? According to the poll, the US recession and Fed tightening seems to be the biggest worry for most of the fund managers. There is a small portion of fund managers who also believe that the earnings slowdown can be a risk for the Indian equities in the near term. So the next question that we ask the fund manager is, how will they tactically position themselves in the current environment? The consensus is very clear. It's between financials, manufacturing, which includes defense, and autos. These three sectors are the consensus for most of the fund managers. As we said earlier, while the earnings growth is a concern for few fund managers, majority of them polled are hoping for over 11% earnings growth in FY24. So earnings is not a risk for most of the fund managers. So we asked the fund managers their near-term Nifty target. While none of them are expecting the Nifty to go below 15,000 levels, the key to note is majority of them are expecting the Nifty to be upwards of 17,000 or maybe even above 18,000 as well. So we also asked the fund managers on their 1 year Nifty target from here on. Going by the poll, it looks like India will continue to outperform, as nearly 77% of the fund managers expect the Nifty to be above 18,000 levels over the next 12 months. So the key to watch is, will the consensus work and will India continue to outperform?